All right, that's not the case. That is when you're actually selling options on stock that you don't physically own. That said, initially, a bit risky. Increased knowledge, very savvy way to invest, okay? Let me give you a little hint on that. It's called selling a put, all right? Selling a put. Let me go over this real briefly. Selling a put means you're selling somebody else the right for them to put you the stock. That's basically about it. So I remember this. It was a stock transaction. I called my old broker. You know what? I've had a few brokers. He was a live broker. I have one live broker left. Why does his name escape me? But his name is a moot point. But he mainly was a stock guy, right? So the stock was at about $17.04, if my memory serves me. And I said, well, listen, I could buy the stock for $17.04. And he said, oh, it's great stock. We've got a strong buy, and great. I took a look at our Success Magazine Investor Toolbox, and we're good to go. We have solid fundamentals and market guide Zacks, and all right. And I said, okay, great. But wait a second. I've learned now a little bit about options. Instead of buying the stock for $17.04, what I want to do is sell somebody else a naked put. I'm going to sell the naked put, the $17.50 naked put. And for that, they're going to pay me $1.50. Well, wait a second. Wait. Let me get this straight. I'm going to sell somebody else the right to have them put me the stock at $17.50. Yeah, that's right. And they're going to pay me $1.50. Yeah, that's right. Which means $17.50 minus $1.50 means my cost basis would be about $16. And that's basically how it works. If that was too fast for you, no big deal. It's just the first part of the day. We'll talk about this later. So I'm selling somebody else the right to put me the stock at $17.50, okay? For $1.50, okay? Cost basis, $16. So far, so good. So I did my research, called the broker up, and I said, you know what? Forget the stock. That's kind of the old school way. I want to trade options. I want to use leverage. I was taught that leverage is a tool of the rich. So I said, here's what I want to do. I want to sell 10 contracts. The naked puts $17.50. And he goes, well, that's too risky. I go, wait, I'm confused. I said you'd sell me the stock for $17.04, right? Yeah, oh, it's a great stock. You got to buy it. Oh, it's great. But I don't want to own the stock. I want to sell somebody else a naked put. Oh, that's too risky. Well, let me get this straight. If I sell somebody else a naked put, that means that gives them the right to put me the stock at $17.50. They're going to pay me $1.50. Yeah, that's right. That means my cost basis would be $16. Yeah, that's right. But you want to sell me the stock for $17.04, and my cost basis would be $16. Help me understand. Well, that's just too risky. You got to buy stock, okay? So again, it's just kind of a little bit of a paradigm shift here. A little bit of a paradigm shift, okay? That's naked options, and then I actually, most of the instructors, I as well have naked index options. That's a next level. I enjoy doing that. Again, even more education and more experience in order to trade that, okay? Naked index options. Option commissions. Option commissions are more than stock commissions, using a round number. There's actually some brokers that are free. Some brokers are $5 or $10 a trade. And you know the most popular brokers. I've mentioned them before, from whatever they may be. The bottom line is that an average trade, as far as a stock is concerned, maybe $10 or $15 a trade. The average option commission is going to be quite a bit more, maybe about $25, maybe $30 a trade, okay? There's some that are a little bit more inexpensive, some maybe a little bit more expensive. That's the basic kind of infrastructure of option commissions. They're a little bit more, they have to do a little bit more work. And I already kind of let you know of the tax considerations of options trading, okay? Get educated on that. If you are interested, go ahead and contact us in our office. We do have some resources for you, maybe some websites we can point you in the right direction for as far as stock considerations go, okay? What is an option? Here we go. An option is a contract that gives the owner the right to buy or sell a stock at a set price on or before a set date. On or before a set date. So let's go back to a real estate analogy, all right? Let's say, I used this before, let's use it again. Let's say I move into your town. I'm going to go ahead and lease option your house from you, all right? So I look at your house. Let's say it's, let me use this example. It's a $200,000 house, okay? I learned a little bit about real estate. Instead of buying the house, I'm going to lease option it, which means I'm going to pay you $5,000 up front. I look at your house, it says for sale by owner. And since it's a FSBO or for sale by owner, I look at that and I say, well, you know what? Instead of buying your house, I'm going to lease option it. Instead of buying it for $200,000, I'm going to give you a check right now for $5,000 up front. The gentleman's listening, right? And he says, well, help me understand this. I said, well, in that case, I have the right to buy your house anytime between now and 2 years from now. All right? And he says, okay, fine. Well, if that stock goes up in value, or if that house goes up in value, or if maybe I do some improvements, or let's say I buy it, I do that lease option very intelligently, and all of a sudden these $1 million homes start going up. What happens to the value of my little $200,000 home? Take a guess. What does it do? It rises in value, yeah. And so all of a sudden, I put a sign in the, let's say 6 months later, all these homes are getting built, maybe a year later. I put a sign in the yard that says, FSBO, for sale by owner, and my number. And then a couple comes by and they see all these $1 million homes and they're getting discouraged. And they see a beautiful house for only $250,000. Today only. And they look at the house and they like it. It's got a fresh coat of paint on it. And they say, yeah, I'll go ahead and buy that house from you for $250,000. All I did is put some paint into it. And they said, well, wait a second. I don't own the stock or the house, but I own something better. I own the option to buy it. And they say, hey, that's fine too. We know that you're a savvy real estate investor, that will work with you there. So we might go through what's called a double closing, where I'll go ahead and they would buy the option from me. They would pay me $50,000, right? And then they would then close on the house. They would then buy the house for what the option says, which is $200,000. They've just spent $250,000. But what did I do? Is I controlled that asset for a period of time, a defined period of time. So you've heard of lease options before. You've heard of this. You've been trading options your entire life. You may have not known what they've been on. For example, you have an option on your house, right? You have home insurance probably. In fact, my home insurance in my neck of the woods is fairly cheap. I don't know, a couple $100, or maybe, I don't even know what it is, $300-400 maybe, something like that. I have some friends now in the Baton Rouge area, and Savannah area, and I said, $200 or $300, and they laughed hysterically. I go, help me understand, why are you laughing? I honestly didn't know. They said, well, it's called hurricane insurance. And I go, well, you don't have that in Columbus, Ohio, okay? And they go, no, it's like, $1,200. And I just never knew that, okay? So you won't own a house without hurricane insurance if you're, living in that neck of the woods. I just never knew, okay? So these things that you may not never know, it would make sense to you that you would own flood insurance and hurricane insurance if you lived in that neck of the woods, but I never knew until I started developing friendships from our workshops that we did in that area. Just, new things, okay? Calls and puts. There's only two types of options, calls and puts. Calls make money when things go up, puts down. Let me do that again. Call up, put down. Call up, put down. Call up, put down. Let's talk about a call first. Here we go. Call option. Let's go over that same kind of real estate example and walk you through it. Now, there's paragraph upon paragraph in your workbook on this, so you're welcome to follow along as you're watching the DVDs. Number one, it says we strike a deal with an owner of a house to buy the house for $100,000 in this example over the next 2 years. All right? In that example, we have the right to close the deal anytime over the next 2 years. All right, class, let me get some interaction here from you. If I have the right to close this on the 2 years, can I go ahead and buy the house next week? Yes or no? Yes. Well, how about 3 months from now? How about 1 year from now? Yeah. How about 2.5 years from now? No, because the option is only valid for 2 years. Remember, the difference between stock and options is that it only lasts a certain period of time. And time is very valuable. Just imagine this. You have a house, and in this case, all right, we'll pay the owner $5,000 right now to motivate him to do the deal. That money is his to keep whether we buy the house or not. Well, let me think about that. Time is valuable because that $5,000 paid for 2 years worth of time. If you are here and you're willing to sell me the option on your house to control your house for, let's say, 30 years for $5,000, I'll buy that right now. That would be ridiculous, wouldn't it? Because that time is very, very valuable. So time is a portion of the pricing model that we use for options, okay? Now, the house increases to $200,000. Why is that? Well, $1 million homes are going up, or the developer comes in and says, we're building the new super mall, and we're buying up the houses in the that are bordering our parking lot, or whatever it may be, okay? For whatever reason, those houses go up in value. Similar to the analogy I just used previously, the owner literally cannot sell the house out from underneath me because I have the right to buy the house from him. Therefore, the house increases in value, Our contract has increased in value, and we can either sell the contract or exercise it and buy the house. All right? We can do one of two things. We can actually physically exercise it. So that means we go to our mortgage broker or whatever, we get a loan on it for $100,000. Then we turn around and we sell it for $200,000. In that case, we just made money. What I prefer to do is I actually have set up the contract properly that it says Michael Drew and or assigns. So we can actually physically take that contract and just sell it to somebody else, okay? That's really the purpose. The purpose of options is not to exercise it and actually physically buy the stock. The purpose of an option is to sell it. This is an incredibly profitable business model, and it's kind of investing by proxy or derivative investing. So we don't invest. In fact, you don't even need to show the ability that you can buy the stock. Literally, you can begin an option account with $5,000, and you can control $100,000 worth of stock. You never have to physically, demonstrate the financial wherewithal to control the stock or to buy the stock. So over here, every option contract has three parts. We have part number one is what's called the strike price. That is the agreed upon price that we are willing to transact at. That is $100,000 in this example. That's our strike price. Now, as far as options are concerned, the basics of options is that the strike prices, if the stock is between, let's take a look at the slide here. If the stock is between $5 to $25 a share, the option strike prices go in $2.50 increments. Therefore, it goes 5, 7.5, 10, 12.50, 15, 17.50, 20, 22.50, and 25. If the stock is in between $25 and $200 a share, we have $5 increments. And therefore, we have 25, 30, 35, 40, etc., etc. If, in fact, the stock is above 200, of which we don't have many right now, however, we will, $200 a share, they are in $10 increments. That's 200, 210, 220, 230, etc. The strike price is the price at which you agree to strike the deal at. All right? Next is the date of expiration. You choose the date of expiration. If you choose that wrongly, you very well may lose your money. Okay, so we're going to go over that extensively. We're just kind of defining the terms right now. The date of expiration. You choose it. It's monthly. Now, technically, options expire. Many of you didn't even know this. Options expire at 11:59 a.m. on the third Saturday of the expiration month. Many of you know that we can't trade on Saturdays, so for all intensive purposes, option contracts expire on the third Friday of the expiration month. Sometimes there may be a holiday event on that Friday. If that's the case, the third Friday is a holiday. The option expiration is on the third Thursday. Okay? So instead, options expire monthly. There are options that expire in January, the third Friday of January, third Friday of March, third Friday of November, whatever it may be. It's the third Friday of those months. Over here, this is the premium. In this circumstance, we paid $5,000. What's the max we could lose? $5,000 in this example, okay? In options, the premium is the money that exchanges hands when you buy or sell an options contract. So we see on the left-hand side over here, we have calls and puts. You receive the bid price when you sell an option. So on the left-hand side here, if you were to sell an option, you would get $2.60. Over here, if you were to sell the put option, you would get 95 cents. You pay the ask price when you buy an option. So let's go right over here to the call area. If you were to buy this option right over here, you would buy it for $2.90. If you change your mind and say, oops, I messed up. I bought the wrong option. You turn around immediately and sell it, you'll be selling it for $2.60. That would be the bid price. I've given several examples of that. It's kind of an easy way to think of it as wholesale retail. Wholesale retail, okay? We buy it full retail, and unfortunately we sell back at wholesale. Some guy says, well, that's a racket. Well, you know what? That's retail, right? That's the same thing that your grocery store does, whether it's a Winn-Dixie or a Kroger or a Meijer or a Albertsons, whatever it may be. It's the same thing that they do. They buy it wholesale and they sell it retail. Finding an option quote. You go right over here to the left-hand side. You click on, in this example, it's PMI, and you come up with PMI Group. You go right over here to listed options. Click on listed options right over here. Or you can go ahead and click on this little optionable link. Either one of those is the same thing. It'll pull up what we call an option chain. This right over here is PMI group. That's the stock. You can see the stock is last trade at $38, okay? Net, bid, ask, etc. It's $38.14. Right over here, these are the November 03 options, the calls and the puts. So we have November 03. The strike prices are in the center. Over here, this is the December 03 options. Calls are on the left, puts are on the right, okay? The option ticker symbol. With stocks, we know, depending on the exchange, we have, our 2 or 3 or whatever it may be, ticker symbol, maybe over the counter, maybe more symbols in the ticker. Well, on options, there's a specific criteria that it follows. Number 1, the first symbol, you'll see right over here on the left-hand side, we have symbols. This is PMI. The first few letters, whether it's 2 or 3 letters, is what's called the option root symbol. The next letter is the option expiration month. In this case, if you'll see, let's look, everybody, if you kind of look at this graph right over here, see it's the next letter is LLLL. That's because that is the expiration call or the put month, which means all these options are in December 2003. If you'll notice that those are the options, the option call or the put month that they're in. Right over here on strike price, that in this case is H. H is right over here. H stands for the strike price. So in this case, H is for the $40 strike price, okay? So let's do an example of a call option. ABC, fictitious company. ABC currently trades at $26 per share. You think it'll rise in the next few months. Why do you think it'll rise? Well, maybe you had used our platinum services of our Turbo Search. You realize that it has a market guide ZAX of 3.25 and above. You realize that it's an uptrending neighborhood, an uptrending big chart. We have 3 green arrows and a heavy volume spike. Everything we've been talking about in our stock class, instead of using the stock, we now use the option. You buy an option contract that gives you the right to buy 100 shares of ABC for $25 a share. All right? Your contract expires in 3 months. So again, if this move happens after 3 months, you're out of luck. Remember, it's 3 months in this contract. You pay $2.50 per share or $250 for the contract. So what's the max you could lose? $250. Now, there are 3 things you can do with the option. You can sell it, exercise it, or do nothing and let it expire. Let me review what I've just said. The stock is at $26 per share. You're going to buy an option at the $25 strike price. They're going to charge you $2.50 for the option, and that is going to control the right to buy the stock anytime between now and 3 months from now. At what price? $25 per share. All right. Now that said, the stock is at the stock's at $26, and we have a $25 call. So let me get this straight. I can buy the stock anytime between now and 3 months from now at $25. Well, is it possible? Is it probable? But let me just say, is it possible using our system that we can find stocks that match our forecast? Absolutely. In this case, it goes to $30 per share. In that case, you would sell your option for $5. Class, what's 30 minus 25? It's $5, right? Right. So in that case, we have $5 per share. Now that's the minimum. If there's more time left, you could probably get more for that, okay? So it goes up. Is it possible that the stock trades flat? And your coaches will be running what are called theoreticals, and they'll run models and what-if scenarios with you that'll say, hey, what if this happens? What if this happens? What if the stock does nothing? What if this $26 stock trades perfectly flat and it closes at $26? Well, you bought the option for $2.50. 26, let's do this with my mouse here, $26 subtract the $25 call option over here is $1. That means you could sell that option, that $2.50 option, for $1. Lastly, is it possible for the stock for you to be wrong? It is possible for you to be wrong. Absolutely. There's times that I'm wrong, or maybe you do your analysis and the market just says, you know what, you're going to be wrong. I'm going to take your money today. It's called the way it is. And ladies and gentlemen, it happens, right? You don't invest all your money in one trade. I've got some experience. I've traded millions and millions and millions of dollars, and guess what? There's times that I'm wrong. There's times that I go up in front of the big bad market and they take my money. Doesn't happen all the time, but it's usually on a news event. Can we control news? We can't control news. And so we don't put all of our money in one trade. We use money management that we learned in our stock class, and we don't do this. But that said, yet there's times that it's going to go against you. So you know what? If you're making money, 8 out of 10 times, and you have proper money management, you and I, we're good to go. Okay? This is a business. This is a business. And you'll make some poor decisions. Welcome to reality. All right? Have you made any poor decisions in your life? I sure have. Right? So in this circumstance here, the option will expire worthless. It goes down to $23 a share. All right? $23 a share. Now let's go back to why we have so many people attracted to options. Well, let's think. If you were to own 100 shares, now run with me on this example. Here we go. You were to own 100 shares of stock at $26 a share. All right? So let's see. What's 26 times 100? Well, my math says that's what's $2,600. Is that about right, guys? Help me. Yeah, it's $2,600. Okay. I've got $2,600 versus I have $2.50 in an option, controls 100 shares, and I have $250. All right? Now, let's run these models, $2,600 stock and $2.50 option, $250. Let's run this model if it goes the wrong way. It goes down to, over here, it goes down to $23. Well, $2,600 down to $23. That means $2,300. You sell, you lose how much? $300, right? 26 minus 23, that's $300. That's the way it is, okay? You go over here to the option model, you've invested $250, and it then goes down to 23, and your option becomes worthless. Meaning, who would pay you anything for the right to buy the stock at 25 if the stock's at 23? Nobody. It's going to become worthless. You lose $250. Well, wait a second. The stock buyer lost $300, and the option buyer lost $250. There's, again, some leverage available for you. That's, as you progress in your knowledge, that's going to become more and more attractive to you, is investing with leverage. So over here, the stock, again, the same example, the stock goes from 26, on the upside. The ABC stock goes from 26 to 30. That's a $4 per share profit, a 15% return. 15% return. Friends, 15%, that's not bad. But let's talk about the option, the leverage investment. ABC goes from $2.50 to $5. That's a $2.50 profit per share. That's a 100% return. Again, just leverage. 15% on the stock and 100% return on the option. So a call option is the right to buy the stock at a set price on or before a set date. You pay money for this option contract. So that's a review of the option contract. That's the right, not the obligation, the right at a set to buy a stock at a set price on or before a set date, and you pay money called a premium. You pay a premium for that right. Okay. The call option is the right. The set price, we call it strike price. On or before a set date, that's expiration date. I'm defining these terms because I'm going to use them fairly fluently throughout the day. And you pay money called the premium. That's the composition of a call option. Now that said, let's talk about a put. Now, everything I've just said, flip it upside down, all right? Most of you folks are bobbing and nodding at home. Maybe you're taking notes. You're on page, whatever page you are in your workbook, and you're thinking, I get that. That makes sense. Again, I had trouble with puts. This next section, you may have trouble